In this video, we're going to continue and complete the cash flow statement. We've already done the income statement, we've done the statement of retained earnings, and we've done the balance sheet. And now we're going to complete the cash flow statement. All right. So when you're doing the cash flow statement, I'm going to encourage you to go to the handout. This handout is going to show you exactly step by step how to complete the cash flow statement. And if you follow these steps, you will do very well. Okay. So here's the cash flow statement. The first thing we do is we start with net income. And that's what it says. Start with net income or net loss from the income statement. So you go to the income statement. Here is the net income. And you bring that over to the cash flow statement up here. If it was a net loss, then you bring the net loss number up here. And that's it. The next step is add any depreciation, depletion, and amortization expense from the income statement. So you go to the income statement and you look for any depreciation, depletion, or amortization. And you only have depreciation because we haven't done depletion yet. We haven't done amortization yet. That's going to be later. So right now you just have depreciation expense, and that's $3,100. Okay, so you bring that over. All right. The next step is it says looks for any losses and looks for any gains. If you have gains, that's a negative. If you have losses, that's a positive. Well, if we look on the income statement, here is the losses and gains section. There is nothing. No gains, no losses. So on the cash flow statement, that's blank. And now comes the part of the cash flow statement that's more challenging. You look for changes in current assets and changes in current liabilities. So you look for changes in current assets, and if there's any increases, you subtract. If there's any decreases, you add. And you can look down here, and the bottom of the section was going to help you. So current assets, these are the current assets. If there's any increases, you subtract. If there's any decreases, you add. So what does that mean? So you go to the balance sheet. Here is the prior year numbers. Here is the current year numbers, right? So we leave cash out. And then we start with accounts receivable, inventory, office supplies, prepaid, and insurance and prepaid rent. We look at the balances for 2019 and we compare them to 2020. So if you look at accounts receivable was 31, it went to 20, it decreased by 11,000. So inventory went from 15,000 to 0, that was a decrease of 15,000. So office supplies went from 27,000 to 6,500, that's a decrease of 20,500. Prepaid insurance was 67, it went to 3,600, that's a decrease of 63,400. Prepaid rent went from 72 to 12, so that's a decrease of 60,000. So these are all decreases. What do we do with decreases? It says if you have a current asset and it decreases, you add, which means you make it positive. So I'm going to say decrease in accounts receivable, decrease in inventory, decrease in office supplies, decrease in prepaid insurance, decrease in prepaid rent, and all of these numbers are going to be positive. And when you look at the cash flow statement, we see accounts receivable, inventory, supplies, prepaid insurance, prepaid rent, and they are all positive. Okay? Now, once you finish with that, what does the handout say? The handout says once you look at current assets, then you go to current liabilities and you follow the rule. Increases in current liabilities are added or is positive. Decreases in current liabilities are subtracted or is negative. And again, you go down here, it says increases you add, decreases you subtract, or increases are positive, decreases are negative. Okay, so we do the exact same thing we did before, but now we're doing it for current liabilities. So here's current liabilities. Here's the 2019 balance. And here's the 2018 balance. Accounts payable went from 130 to 2,500. That's a 127,500 decrease. Interest payable, utilities payable, salaries payable, they went from amounts to 0. So that's definitely a decrease, right? So a $30,000 decrease, $13,000 decrease, $12,000 decrease. Unearned revenue went from 29,000 to 90,000. That's an increase. So we had an increase in unearned revenue, which means we have $61,000 increase. So here are our decreases and here's our increase. So what do we do with that? Well, if you look at the handout, the rule is there. Increases are positive. Decreases are negative. So we add increases, we subtract decreases. So I'm going to enter all these decreases as negative, and then the increases as positive. So you're really entering on a cash flow statement the change between the current year and the prior year. So you'll see accounts payable, decrease in accounts payable, decrease in interest payable is negative, decrease in utilities payable is negative, decrease in salaries payable is negative, and then increase in unearned revenue, that's positive. All right, so I'm going to take my net income and I'm going to add all of these numbers together and I come up with 100,900 positive, that is my net cash from operations. If it's positive, it's net cash provided. If it's negative, it's net cash used. All right, so that is the operating activities. And now we go to investing and financing activities. In order to do the investing and financing activities, you use the other information. So you use the other information section, and that's how you populate investing and financing activities. The first thing you should do is you should go through this list and figure out what's investing and what's financing. If you don't remember, go back to the handout, right? Here's it says, investing activities deal with long-term assets. Financing activities deal with long-term liabilities and equity. So anything that's a long-term asset is going to be in investing. Anything that's long-term liabilities or equity is going to be in financing. All right, very simple. So let's look at this. Land, what is that? That's a long-term asset. It's investing. Furniture is also a long-term asset. It's investing. Equipment is a long-term asset. That's investing. Company stock, that's equity. So that's financing. Company stock again, that's equity, so that's financing. Dividends, that's equity, so that's financing. So we have 3 investing activities and 3 financing activities. And for both of these, the rule is simple. If you spent cash, then cash decreased, so you put it as a negative. If you sold something and received cash, then you put that in as a positive because you received it. Same thing with financing activities. Any transaction that resulted in an increase in cash, you add. Any transaction that results in a decrease in cash, you subtract. All right, so let's take a look at it. So here we have the investing section. Cash receipt from sale of land, $10,000 positive. Land was sold for $10,000, so that's positive. Furniture was purchased for $20,000 in cash. So we lost cash, or we exchanged cash for furniture. So we're going to have here cash payment for the acquisition of furniture, $20,000. Cash payment for the acquisition of equipment, negative $100,000, because we purchased equipment for $100,000 in cash. So we have 2 negatives and 1 positive. So I'm going to take the 10,000 positive plus the 20,000 negative plus the 100,000 negative. I add those together, I get 110,000 negative. So this was spent on investing activities. Now we go to financing activities. We do the exact same thing, right? The company sold stock. Whenever you sell stock, you receive cash. So you sold stock and you receive $500,000 in cash. If we look at this, it says cash receipt for the sale of common stock, $500,000 positive. Then we have company stock was purchased. You purchased stock with cash. That's going to be negative. So 252,000 negative. And then you paid cash dividends, which is going to be cash you used. So that's 26,000 negative. So I add up all of these and I get net cash provided by financing activities of $222,000. So now I have my operating activities number, I have my investing activities number, I have my financing activities number. I add those 3 numbers together to get the net increase or decrease in cash. So 100,900, 110,000 plus 222,000. I add these 3 together. Notice the 110,000 is a negative. So a positive 100,900, a negative 110,000, a positive 222,000. When I add those 3 together, I get 212,900 as my net increase or decrease in cash. It's an increase because it's positive. Now I check this. How do I check this? Well, I go to the balance sheet and I compare my beginning and ending cash balance. So here's my balance sheet. The current year cash balance is my ending cash balance. The prior year cash balance is my beginning cash balance. So the 2019 balance is my beginning. The 2020 balance is my ending. So I put in here my beginning and my ending. I take the difference between these two. When I take 412,900 minus 200,000, I get 212,900. So the difference between beginning and end is 212,900, which should equal the net increase or decrease in cash. And it does. So that means my cash flow statement is correct, assuming I didn't make any math errors. All right. So that is how we do the cash flow statement. Once we have the income statement, statement of retained earnings, and balance sheet complete, we can then do the cash flow statement. So now you've done the 4 financial statements with the trial balance that you've created.